Welcome to The Deep Dive, the show where we take a stack of dense research and distill the critical insights you need to be truly well-informed. Today, we are wrestling with a serious paradox in high-growth tech, the trade desk, or TTD.
Right.
This is a company that's widely seen as the infrastructure backbone, the operating system for the entire digital open internet. And yet, as of late November 2025, its stock is down a staggering 60% year-to-date.
60%. I mean, that's a catastrophic collapse by any measure. It really suggests terminal problems or maybe a valuation that was just completely diverse from reality.
Exactly.
And for investors, this creates what we call a moment of dislocation.
Yeah.
So our mission today is to cut through that immediate panic and examine this business solely through the lens of fundamental value-based investment principles.
The kind of framework used by firms that are looking for durable competitive advantages, not just a quick trade. So we're essentially asking, did the underlying quality of this franchise just vanish overnight, or did the market violently overreact to a major external shock?
And we've structured this deep dive into 7 distinct, detailed steps. We're going to cover everything from the proprietary technology that gives TTD its edge, all the way to the specific macroeconomic variables that cause this entire ad market to just seize up.
And I think we should frame our expectation early, even though we'll say the final verdict for the end.
I agree. The totality of the analysis really suggests a powerful dichotomy here. A durable, wonderfully designed company that has run headfirst into a temporary but brutal cyclical contraction.
So we need to spend the next several minutes really proving that quality piece by piece against this backdrop of just massive stock volatility.
Let's get to work and prove the resiliency of this business model.
Part 1, chapters 1 to 3, business management and financials.
Chapter 1. Business understanding.
Okay, so to start, we have to define exactly what TTD sells, because ad tech is, well, it's a term that often obscures the actual value proposition.
It really does.
The sources identified TTD as having a franchise quality. So what is the precise nature of this competitive advantage, and what is its moat?
The moat is built almost entirely on neutrality and alignment. TTD is a demand-side platform, a DSP.
Right.
And you should think of it as the essential, sophisticated software operating system used by large advertisers and agencies to manage their ad spend.
Okay.
And critically, it operates on the open internet, meaning everything outside the behemoths like Google, Meta, and Amazon. Those are the walled gardens.
And that distinction between TTD and a walled garden,
Yeah.
that's where the neutrality moat comes in, right?
Absolutely. When a brand spends $1 million inside Google's ecosystem, Google is acting as the seller of the ad space, the technology provider, and the broker facilitating the transaction.
So they're on all sides of the deal.
Exactly. It's an inherent conflict of interest. Google is incentivized to maximize its own revenue, not necessarily the efficiency of the buyer's spend.
Right.
TTD is structurally different. They are purely the agent of the buyer, the advertiser. Their sole incentive is maximizing the return on ad spend, or ROAS, for their client. And that buyer alignment is a massive differentiator in an industry that's just plagued by opacity.
That sounds great in theory. But where is the tangible evidence? Where's the proof that this neutral stance actually translates into a durable franchise?
The evidence is pretty much indisputable, and it's the most compelling single data point in our sources. TTD has maintained a customer retention rate of over 95% for 11 consecutive years.
11 years. Wow.
This level of stickiness proves that once advertising agencies integrate their complex proprietary data sets and build their custom workflows onto TTD's platform, the switching costs become prohibitive.
So they're just locked in.
They're locked in.
Yeah.
If an agency tried to move a major campaign to a rival DSP, they would face massive expense in retraining hundreds of employees, risking immediate performance degradation, and losing historical performance data compiled over years. That 95% retention rate is the ultimate proof of a durable moat.
Okay, let's pivot to the technology that powers that retention. Kokai AI. We're talking about a system that replaced their previous architecture, Solimar, because the scale of the programmatic ad market now just exceeds human capability.
Oh, completely.
How massive is the scale TTD is operating at?
The scale is astronomical, and it's constantly expanding. The platform has to evaluate in real time 15 million ad opportunities per second.
15 million.
Per second. That requires distributed AI and deep learning, what TTD calls Kokai tool, instantaneously determine the precise value of an impression based on device type, user behavior history, current context, and thousands of other variables.
So Kokai isn't just an add-on.
No, it's the core intellectual property. It's what allows TTD to allocate capital more rationally than its, human-driven competitors.
And here's where it gets really interesting, because the sources provide tangible, quantifiable evidence that this technology is actually superior, not just some proprietary marketing fluff.
Right, the numbers back it up.
What are clients who use Kokai actually reporting?
So the data confirms the technological moat is not only there, but it's actively widening. As of Q3 2025, 85% of TTD's clients utilize the Kokai platform.
That's a huge adoption rate.
It is. And the results are a 58% improvement in cost per unique reach and a remarkable 94% better click-through rates compared to clients still relying on legacy systems or simpler bidding algorithms.
94% better.
Think about that implication. When a CMO looks at those numbers, TTD becomes the only rational choice. If TTD can nearly double your click-through rate, allocating capital anywhere else is, well, it's financially irresponsible, especially during an economic slowdown.
That makes TTD sound utterly dominant. So if the business quality is this high, the technology is superior, and the customer retention is nearly perfect.
Why are we even having this conversation?
Great.
Why is the stock down 60%?
And we finally arrive at the external shock, which has to be understood in great detail. Macroeconomic volatility driven by trade policy and aggressive U.S. tariffs. This is the sole source of the market's panic, and it has absolutely nothing to do with the TTD's core technology failing.
Let's rewind a bit. Where did this massive, sudden wave of ad spend come from, and why did it just vanish so quickly in 2025? It originated primarily from Asia-based e-commerce giants, most notably Shein and Temu. They were spending aggressively to conquer the U.S. consumer market in 2023 and 2024.
Okay.
Their whole strategy relied almost entirely on a specific trade loophole, the de minimis tariff exemption. This policy allowed individual packages valued under $800 to enter the U.S. duty-free.
And that dramatically lowered their cost of goods sold.
Exactly. And it allowed them to aggressively allocate those savings toward customer acquisition, mainly through digital advertising on platforms like TTD.
So when the trade policy reversed in 2025 and that de minimis exemption was removed or severely curtailed, what happened to their unit economics?
They imploded. The instantaneous increase in import duties just broke the foundation of their entire U.S. acquisition model.
And when margins get pressured?
The very first budget line item to be slashed is advertising, which is viewed as a variable expense. Our source material highlights the specific massive impact. Temu reduced their U.S. digital advertising expenditures by 31%.
31%.
And Shein cut their spend by 19%. This wasn't a gradual slowdown. It was a sudden, multi-billion-dollar vacuum created overnight, directly impacting the entire digital ad ecosystem, TTD included.
Wow, those specific percentages truly reveal how exposed the ad market is to global trade policy. A risk most investors are just not tracking when they analyze a high-growth tech stock.
No, not at all.
So if we connect this shock to the bigger picture, the 60% decline is fundamentally a market-wide stress test, right? Reacting to an external contraction in demand rather than an internal structural flaw.
That is the crucial distinction. The company didn't suddenly get worse. A massive amount of high-margin temporary revenue simply disappeared because of politics.
So the immediate operational challenge for management became, how quickly can we pivot? And where do we find the necessary countergrowth to buffer this enormous retail headwind?
And the answer is strategic diversification, which, to their credit, TTD has been pursuing for years.
Okay, let's examine that resilience. The first major driver is connected TV, or CTV. We know the secular shift away from linear TV is massive.
It is the defining trend in advertising for the next decade. Linear TV viewership is collapsing. It's now falling to just 12.4% of total global ad spend.
And all those budgets have to go somewhere.
They have to. Those massive budgets from CPG, auto, finance are migrating to streaming platforms, and TTD is positioned perfectly to capture that shift. Video, which includes CTV, already represented approximately 50% of TTD's business in Q3 2025.
To 50%.
This move into CTV provides a multi-decade growth runway that is entirely insulated from the specific tariff issues impacting Asian retail. When Disney Plus or Netflix sell an ad, TTD is often the engine ensuring that ad reaches the right viewer at the right price for the advertiser.
And then there's retail media, which feels like a brilliant strategic countermove against the walled gardens.
It is.
Retailers have the holy grail of data. Closed-loop attribution, meaning they know exactly what you bought, not just what you looked at.
Precisely. TTD recognized that the only way to compete with Amazon's purchase data is to aggregate the data from Amazon's competitors. So they're leveraging partnerships with major retailers like Walmart and Target to ingest that closed-loop shopper data.
And this lets brands target consumers on the open internet.
Right, outside the retailer's own site based on offline purchase behavior. This positions TTD as a vital partner to retailers who want to monetize their first-party data, establishing TTD as a foundational layer in this rapidly emerging retail media sector.
We should also note the geographic diversification, which helps mitigate concentration risk. North America is still dominant, accounting for 87% of Q3 revenue.
It is, but the sources indicate that international growth is currently outpacing North America, which will provide a necessary long-term hedge.
Okay, so summing up the business understanding, we are looking at a classic toll bridge franchise.
That's a great way to put it. TTD sits at the intersection of supply, publishers, and demand, advertisers, takes a high-margin slice of every transaction, benefits from superior technology with Kokai, and enjoys nearly perfect customer retention at 95%.
The business quality is extremely high.
The problem is external and cyclical, not structural.
Chapter 2. Management Evaluation.
We shift now to the qualitative assessment of the management team. When you're evaluating a high-quality franchise through a value lens, the person steering the ship is just. It's paramount.
So who is Jeff Green, and what does the research say about his motivation and his alignment with long-term shareholders?
Jeff Green is the definition of an owner-operator. He's a founder-operator, having previously founded ECM. So this history of building sophisticated ad technology from the ground up gives him deep domain expertise.
And he's aligned with the long-term vision.
Critically, yes. He has a philosophical commitment to the open internet, positioning TTD as the champion against the data consolidation of the walled gardens.
And I found the detail about his personal integrity fascinating. He's a signatory of the Giving Pledge, committing to donate the majority of his wealth to philanthropy. How does that factor into our assessment of his leadership?
Well, that's a strong signal of legacy motivation. It suggests that his drive in running TTD is tied to actualizing his vision, making the open internet a functional reality rather than, just chasing quarterly compensation bonuses.
Right.
This long-term legacy-driven motivation tends to lower agency costs and reduces the risk of management making short-sighted decisions that benefit them personally over the stability of the company.
We judge operational resilience best during adversity. TTD has navigated volatility before, but how is management responding specifically to this 2025 tariff shock? Are they making excuses, or are they proactively addressing the problem?
They're responding proactively by focusing on making their clients' remaining advertising dollars work harder. They call it supply path optimization, or SPO. They are using Kokai's advanced AI capabilities to identify double-digit percentage efficiency improvements for clients, which involves eliminating unnecessary middlemen in the transaction process.
So if a client's margins are shrinking due to tariffs,
TTD helps them offset that by generating higher ROAS from the existing spend. This action is critical because it strengthens client trust and stickiness precisely during a period of stress.
now let's talk about capital allocation, which is the most tangible measure of management's confidence in their own stock. TTD has shifted toward an aggressive capital return policy during this dip. What is the signal management is sending to the market?
They are signaling overwhelming conviction that the stock is deeply undervalued. When a company uses its balance sheet strength to buy back stock heavily at a 60% discount, they are essentially stating they believe they are buying $1 of future cash flow for 50 cents or maybe even 40 cents.
And the scale of this opportunism is immense.
It is. In Q3 2025 alone, they deployed $310 million to repurchase Class A stock.
And that number is part of a larger long-term commitment.
Exactly. Since the repurchase program's inception in 2023, TTD has repurchased nearly $2 billion in stock.
$2 billion.
And demonstrating their conviction remains high, they authorized an additional $500 million buyback in October 2025. This strategy is only possible, and crucially, only responsible, because the company maintains a financial fortress: zero long-term debt.
That zero debt figure is a phenomenal advantage. It means they incur zero interest rate risk and, in fact, are earning interest on their cash pile in this high-rate environment, which, very few high-growth tech companies can claim.
That flexibility is the ultimate ace up their sleeve. It allows them to execute these opportunistic buybacks without risking financial stability. However, we have to address the major skepticism point raised in the critique: stock-based compensation, or SBC.
Right.
For the first 9 months of 2025, TTD reported $378 million in SBC expense. That's a significant legitimate cost.
So nearly $2 billion in buybacks is huge. But doesn't that massive SBC expense mean the buybacks are just treading water? Rather than truly retiring shares and creating value, how does management defend that high SBC?
That's a necessary challenge. And the sources confirm that management is acutely aware of this perception. They explicitly used the buyback program not just as an opportunistic valuation play, but as a deliberate defense against dilution.
Okay.
They stated that the repurchases are focused on effectively offsetting dilution and reducing shares outstanding. So while many tech peers let their share counts balloon year after year, TTD is using its cash flow to neutralize the dilution inherent in compensating highly skilled engineers and software developers.
So the net effect is at least keeping the share count stable.
According to their reporting, yes, which differentiates them from less disciplined management teams.
Chapter 3. Financial Health.
Now we transition to the hard numbers, moving into the Q3 2025 operating performance. This quarter is vital because it captures the immediate financial effect of the tariff shock.
Right. And despite that external headwind, how did TTD perform?
They executed remarkably well under extreme pressure. Q3 2025 revenue was $739.4 million, which represented an 18% year-over-year increase.
And it beat expectations.
Critically, yes. This figure beat the analyst consensus estimates of $719.3 million, showing that even the worst-case scenario wasn't as bad as the street had feared.
But that 18% headline growth figure is actually misleading when you're trying to assess the underlying core business strength.
It is.
You need to factor in the political spend distortion from the prior year.
That's a vital adjustment. The comparable quarter in 2024 included a significant amount of temporary political ad spending due to the election cycle.
Right.
When you exclude that cyclical political revenue from the prior year's baseline, the implied core commercial growth rate for Q3 2025 was actually 22%.
22%.
And that 22% figure tells the real story. The secular growth engines, CTV and retail media, are growing at a clip that far outpaces the headline 18% figure, proving that the tariff shock, while painful, did not cripple the entire company.
Let's discuss profitability. A highly scalable software platform should exhibit significant operating leverage. Does TTD meet the criteria for elite profitability?
It absolutely does. Adjusted EBIT for Q3 2025 hit $317.5 million. And if you calculate the margin, that translates to an EBITDA margin of 43%.
Which is actually an expansion from the prior quarter.
An expansion from 39%. A 43% margin is not just high, it's elite, comparable only to the most dominant software platforms globally, and it provides an immense competitive and financial buffer. Their non-GAAP EPS of 45 cents also comfortably beat consensus expectations.
So why is that 43% EBITDA margin so important in the context of the tariff shock and a potential recession?
It's the ultimate margin of safety. If ad spending were to suddenly contract further, say, another 10%, the high variable cost nature of TTD's platform combined with that 43% margin means the company can still absorb major hits and remain highly profitable.
Right, because most of their costs aren't tied to inventory.
Exactly. They're related to infrastructure and R&D. This operational efficiency is what ensures the company avoids financial distress when competitors might be facing insolvency.
Let's look at the balance sheet again, the ultimate fortress. We already noted the zero long-term debt. What are the specific liquid reserve numbers?
The company has over $1.4 billion in total liquid reserves, which breaks down into $653 million in cash and $792 million in short-term investments.
And total debt, zero.
Total debt is $0. This flexibility means they are entirely insulated from rising interest rates. In fact, they benefit from them by earning a healthy return on that $1.4 billion cash pile.
And working capital.
Looking at working capital, their total current assets, $5.12 billion, cover their total current liabilities, $2.99 billion, but a factor of 1.7x, confirming a highly robust and non-stressed working capital position.
This high quality translates directly into prodigious cash flow generation, which is where the true owner earnings reside. How efficiently does TTD turn that elite EBITDA into cold, hard cash?
The conversion rate is exceptionally high, which is the defining hallmark of a capital-light software business. Operating cash flow for the first 9 months of 2025 reached $681 million.
And free cash flow.
If we run the free cash flow calculation, which accounts for necessary capital expenditures and capitalized software costs, we arrive at approximately $502 million in free cash flow for that 9-month period.
So for the listener, why is that high conversion rate EBITDA flowing almost straight through to FCF so important compared to, say, a manufacturing company?
Well, a capital-intensive business, like a manufacturer or even a social media giant that needs to build massive data centers every year,
Mhm.
sees a huge drop between EBITDA and FCF because of CapEx.
Right.
TTD, as a software platform, has low maintenance capital needs. They invest heavily in R&D, like Kokai development, but their physical capital requirements are minimal. This means their profit is highly convertible into discretionary cash, which management can then use for buybacks, acquisitions, or further strategic R&D, creating a powerful compounding effect.
Finally, let's formally run the tariff sensitivity stress test, tying the business risk back to the financial reality. What happens in the absolute worst-case scenario if the macro environment forces overall U.S. ad spend down severely?
The analysis suggests that if the tariff shock were to generalize and reduce U.S. ad spend by a very severe 10%, TTD's revenue growth could decelerate sharply, potentially into the single digits. This is the scenario the short sellers are betting on.
What?
But thanks to the variable cost structure and that 43% EBITDA margin, the company would remain fundamentally profitable, cash generative, and financially flexible. They wouldn't face insolvency, they would simply face a temporary growth slowdown. This operational stability forms the core of the margin of safety for long-term investors.
That deep dive into the business, management, and financials is already extremely revealing. If you appreciate this level of detail on complex financials and operational resilience, we encourage you to stick with us as we pivot to competition and final valuation.
And before we move on, we want to invite you to join our growing community of informed investors.
Like and subscribe to Stock Analytics AI.
And for true deep dive fanatics who want this level of analysis on hundreds of companies.
For 4.99 month, get 500 plus deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members only requested deep dives.
Now let's pivot to the competitive landscape and the specific risks that continue to generate volatility.
Part 2. Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion.
Chapter 4, Market Sentiment.
Okay, we've established the neutrality and 95% retention as core moats. Let's focus on two other critical areas that define TTD's competitive position: the platform workflow and the development of the next-generation Internet identity solution.
Right, the high switching costs. They're often invisible to outsiders, but they are very real for the agencies. TTD isn't just a place to buy ads, it's a fully integrated workflow solution.
So it's more than just a button you push.
Oh, much more. Traders build custom bidding algorithms using Kokai. They integrate their clients' proprietary first-party data, and they benchmark against TTD's immense repository of historical data. To walk away, they face retraining costs, the expense of migrating complex data sets, and the immediate risk of campaign failure.
And that explains the 95% retention rate.
It's a direct reflection of how high those costs are.
The next major pillar of the moat is Unified ID 2.0, or UID2. This addresses the foundational shift in the entire advertising industry, the eventual deprecation of the third-party cookie. This has been called TTD's network effect flywheel. How exactly does UID2 function, and why is TTD driving this industry solution?
So UID2 is TTD's essential answer to identity management in a post-cookie world. It's an open source framework, which is important because TTD doesn't own it entirely, which just reinforces their neutrality thesis.
And how does it work?
It works by taking users' encrypted email addresses, which they've willingly shared with publishers, and converting them into a standardized, tokenized ID that allows advertisers to target them effectively without using invasive third-party tracking.
So how did this create a flywheel, a self-reinforcing network effect?
Well, it creates leverage for both sides of the transaction. On the supply side, premium publishers, think Disney, NBC Universal, Paramount, they adopt UID2 because inventory carrying a UID2 token fetches a higher price, which increases their revenue.
And on the demand side?
On the demand side, advertisers adopt UID2 because it provides the precise targeting capabilities they need. So as more publishers join, the utility for advertisers skyrockets and vice versa.
So it's becoming the standard.
It is quickly becoming the de facto currency of the open internet, the standardized language that the entire programmatic ecosystem outside of Google and Meta speaks. Smaller DSPs or identity solutions just lack the scale and adoption necessary to compete with this foundational infrastructure.
Now let's address the competitive oligopoly. TTD focuses on the open internet, which is where consumers spend about 90% of their time online, outside of the specific domains of the walled gardens.
Right.
Does TTD benefit from any regulatory tailwinds in this regard?
Yes, potentially massively. The ongoing U.S. Department of Justice antitrust litigation against Google's ad tech stack is a structural advantage for TTD.
How so?
Well, Google is accused of monopolistic practices by bundling its ad exchange and publisher services. If the DOJ mandates the unbundling of Google's ad tech stack, TTD, as the leading neutral partner, stands to gain substantial market share as agencies seek partners free from regulatory risk and conflicts of interest.
However, the immediate and acute threat is not Google, it is Amazon DSP. The sources call Amazon's strategy a Death Star approach.
Yeah, that's a good name for it.
Given the $50 billion size of Amazon's advertising business, what makes them such a formidable existential threat to TTD?
Amazon's threat is entirely data-driven and inventory-driven. They have aggressively expanded their DSP, but their primary weapon is bundling. They use highly desirable premium inventory, especially Prime Video, which offers a massive, engaged, and upper-middle-class audience.
And they basically give the tech away.
They often offer aggressive incentives to agencies, sometimes covering the entire ad tech costs, to encourage bake-offs against TTD.
But the real power is the data, right?
Exactly. Amazon's closed-loop purchase data is unmatched. Their pitch to agencies is simple and devastating. You can buy a programmatic ad on the open internet via TTD and hope it works, or you can buy an ad through us and we know instantly if that person purchased the item after seeing the ad.
That's a killer pitch.
The ability to close that attribution loop instantly is Amazon's ultimate competitive advantage.
So how does TTD stack up against this seemingly overwhelming data dominance?
TTD's counter strategy, leveraging those retail media partnerships, is critical. Instead of trying to own the inventory, TTD is aggregating the data from Amazon's primary rivals, Walmart, Target, Kroger, and others.
Okay.
This allows TTD to offer a massive, aggregated, non-conflicted data targeting alternative to Amazon. Jeff Green's argument is that Amazon's DSP is primarily excellent for driving sales on Amazon, while TTD dominates the rest of the web, which is the vast majority of consumer time.
So a battle of ecosystems.
Amazon's closed loop versus TTD's aggregated open internet loop.
Exactly.
Finally, how does TTD compare to its independent peers, like supply-side platforms, SSPs, such as Magnite?
TTD sits in a league of its own. It is the buy-side leader, commanding demand, which provides it with inherent leverage over the supply side. Its core growth rate, that 22% ex-political figure, is substantially higher than SSPs like Magnite or identity partners like LiveRamp, who generally track closer to flat or low single-digit growth.
And that's why it gets the premium valuation.
It commands a premium valuation because it is the crucial aggregator of buyer demand, not just a provider of supply infrastructure.
Chapter 5. Ownership structure. Let's look at who is holding TTD during this extreme volatility. Institutional confidence is often seen as a barometer of long-term belief in the business model.
Right, so what do the major institutional holders tell us?
While institutional support remains robust, which provides external validation that the smart money sees this tariff shock as temporary. We see Vanguard holding a significant position of 11.76% of the company, and BlackRock holds 7.43%.
And these are patient, long-term capital allocators.
Exactly. They do not jump ship over cyclical macroeconomic pressures.
However, the volatility confirms there is significant market skepticism, which is quantified by the high short interest.
That's the balance we have to acknowledge. Short interest is high, ranging between 10% and 11% of the total float. This is a powerful, tangible indicator that a large portion of the market believes TTD cannot sustain its premium valuation or its growth trajectory against these intense pressures.
So they're betting on further deceleration.
That's the bet.
While open market insider buying often cheers up investors during a dip, the Force material noted that such buying has been sparse. Why is the large-scale corporate share repurchase program a more meaningful proxy for insider belief than any individual transaction?
Because individual insider transactions, even large ones, can be influenced by personal liquidity needs or timing. The corporate repurchase program, however, involves the management team taking nearly $2 billion of the company's precious, hard-earned FCF and deploying it to buy back shares.
It's a statement.
It is a cold, calculated signal that the board and the CEO believe the stock's intrinsic value is far higher than the current market price. It is the strongest, most tangible proxy for insider confidence available.
Chapter 6. Risk Assessment.
We need to systematically review the risks that currently justify the 60% haircut, starting with the primary near-term threat, the macroeconomic and tariff risks.
Right, that's the big one.
The tariff shock remains the single largest quantifiable risk. We've seen the direct impact, those 31% and 19% spending cuts from key retailers. If global trade wars escalate, or if the U.S. economy enters a deeper recession, This phenomenon could spread across sectors dependent on global supply chains, shrinking the overall aggregate demand for advertising significantly.
We quantified the extreme downside scenario earlier. What's the maximum pain TTD could endure before hitting financial trouble?
The stress test showed that a severe 10% reduction in U.S. ad spend could theoretically push TTD's revenue growth down into the single digits. This is the scenario that would truly test investor patience and justify that high short interest.
But critically, we established the safety buffer.
Right. The variable cost structure and the 43% EBITDA margin mean even in that severe downturn, TTD remains profitable and cash positive. The risk here is growth deceleration, not bankruptcy risk.
The second acute risk is the competitive intensity posed by Amazon, the Death Star.
This is the structural risk that keeps long-term investors cautious. If Amazon successfully utilizes its inventory advantage, like Prime Video, and its data dominance with purchase history to weaken the core thesis of the open internet, then TTD's moat could be chipped away over several years.
So TTD is forced to spend heavily on R&D and partnerships.
Just to maintain parity and data quality, it turns this into a high-stakes, ongoing battle for the future of non-walled garden programmatic advertising.
Finally, let's address valuation risk head-on. Even though the stock is down 60%, it still trades at a high multiple.
It does. The trailing PE ratio is still high, approximately 43.8x. Now, this is far cheaper than it was 2 years ago, but it is still priced for growth.
So if growth decelerates faster than expected,
If it decelerates faster than the 16-17% expected by analysts over the next year, the stock is clearly overvalued based on traditional metrics. This high multiple means the stock is highly sensitive to negative earnings revisions or further macroeconomic shocks.
so if the stock is still priced for growth, where's the margin of safety that a value investor demands?
The safety lies entirely in the quality of the balance sheet and the profitability. The 43% EBITDA margins guarantee that earnings are robust and defensible.
And the cash cushion?
And that $1.4 billion cash cushion with zero debt provides extraordinary optionality and a capital buffer. This financial fortress allows management to be patient, ride out the cyclical shock, and capitalize on opportunities like buybacks when the market misprices the stock. That flexibility is the ultimate margin of safety.
Chapter 7. Conclusion.
We've established the business quality, assessed management, navigated the competitive threats, and quantified the risks. Now, let's bring it all together with the final valuation snapshot and the ultimate verdict on this 60% decline.
So the market cap reduction has been dramatic. The current stock price is $39.56, giving the company an enterprise value of approximately $17.8 billion.
And we have to compare that enterprise value to the intrinsic value, which is derived primarily from future free cash flow generation.
So let's run the discounted cash flow, the DCF analysis, to bridge that gap.
In the base case, where TTD deals with continued macro pressure and achieves a conservative 15% FCF growth rate over the next decade, the intrinsic value is estimated to be roughly $20 billion to $22 billion.
And the observation here is critical.
The current $17.8 billion EV is trading at a clear, though small, discount to even this conservative scenario.
And the bull case.
In the bull case, where TTD successfully executes its CTV and retail media strategy and maintains 20% FCF growth, the intrinsic value exceeds $30 billion.
So the valuation compression caused by the 60% decline has succeeded in moving TTD from clearly expensive territory into the realm of a fair price for a high-quality compounder.
Yes, it's no longer the speculative bet it once was.
That is the ultimate conclusion derived from the sources. So let's confirm this quality by running the classic Buffett checklist one last time.
Good idea.
First, is the business simple and understandable?
Yes. It is a broker for digital advertising. It's the software that buys ads for big brands on the open internet.
Second, does it possess a durable competitive advantage or a moat?
Absolutely. The moat is high switching costs, that 95% retention, the superior technology of Kokai, and the network effect established by UID2, which is becoming the necessary identity currency of the open internet.
And third, is the management able and trustworthy?
Yes. Jeff Green is a philosophically driven founder-operator, and the rational capital allocation, particularly the opportunistic buybacks used to neutralize dilution, confirms a strong alignment with long-term shareholders.
Okay, the final verdict then, based on the totality of the sources and our analysis of the intrinsic quality versus the external shocks.
The long-term bull case is, I think, unavoidable. TTD is the critical infrastructure for the inevitable shift of massive linear TV budgets into connected TV. CTV is already 50% of the business and growing rapidly. The technology is superior, the financial stability is pristine, and the customer base is locked in.
Therefore, the 60% decline is a severe overreaction to temporary tariff headwinds that mask the underlying 22% core growth rate.
Correct. TTD merits a buy rating for long-term investors who can look past the noise and tolerate the near-term volatility caused by macro events, betting on the durability of the franchise and the secular shift in advertising budgets. The discount offers a necessary margin of safety.
What a fantastic deep dive. It truly highlights how quickly a technologically dominant infrastructure-level company can drop so sharply, emphasizing the sheer power of external macro events like trade policy and tariffs versus the internal business quality demonstrated by Kokai and that 95% retention rate.
The market has priced in the panic, but our analysis of the source material suggests it has not fully priced in the resilience and the long-term compounding power.
Which leaves us with the final provocative thought for you, the listener, to mull over. The core structural question for 2026 isn't about Amazon or Google's aggression, it's about elasticity.
Right.
Will the robust structural growth of connected TV and retail media be enough in 2026 to entirely fill the vacuum left by the Asian e-commerce ad spend contraction, allowing TTD to accelerate back to 30% plus growth?
That decision point, that critical inflection, is the next frontier for TTD.
Thank you for joining us for the deep dive. If you found this analysis valuable,
Like and subscribe to Stock Analytics AI.
please remember that this entire deep dive is based on AI research source material and is intended purely for informational purposes. This is not financial advice. We always encourage you to conduct your own comprehensive due diligence before making any investment decisions.
Until next time.